Thank you so much for joining today's webinar. I know times like these can be a bit uncertain and overwhelming. Today's not going to be your typical financial webinar. We're not going to show you 37 ways to get rich in the stock market. We're going to be showing you some real world math. Now, before you click out at the mention of the word math, our goal is to give you information that a lot of advisors throughout the country do not have. What you choose to do with that information is entirely up to you. Throughout the webinar, you're going to see a lot of this pertains to creating the best financial portfolio that suits your needs. However, this information can pertain to all financial aspects of your life. You'll see what I mean later on the webinar. So, before we get started today, I briefly want to go over some of the options you have throughout this webinar. Typically, we like to ask you guys to block off 20 to 30 minutes so we have your full and undivided attention. However, we do understand some things can come up. I myself have a 2-month-old baby boy at home, so I know if I hear Andrew scream to my household, chances are I'm going to have to change a poopy diaper. So we get it. So something like that does come up. We encourage you to type in the questions bar, hey, I couldn't make it through, please contact me later. Either Rich and I will get back to you, we'll fill you in on some of the parts that you missed. However, when you do reach the end of the webinar, we do encourage you to schedule that call. This will allow us to have an exploration call with you. So when you click that button, you'll have a list of days and times that work best for you. Please select that. Either Rich and I will get back to you. We do email messages, we do Zoom calls, and we even do good old-fashioned phone calls. So without further ado, I'd like to introduce you to our speaker, Mr. Richard Hansen.
Hi everyone, welcome to our webinar session, Is Coronavirus Killing Your Retirement? As Drew said, we hope to be in a position today that you'll gather some data and some information that might help you navigate through the tumultuous times that we're in today. A little bit about me and who we are. I started the business in 1983, so I've seen several ups and several downs in the marketplace. Nothing compares to what we're going through today. Our firm has been in South Orange County since 1983 in San Clemente and San Juan Capistrano. Our current office is in San Juan Capistrano, right by the Mission. I live in Dana Point, and our objective working with all our clients is we utilize a number of different tools at our disposal to help our clients get to where they need to go. Some of those products are mutual funds, stocks, bonds, annuities, CDs, money market accounts, long-term planning vehicles like long-term care, Medicare supplements, life insurance, disability insurance. We work with employee benefits, 401ks, and employee medical insurance. So we run the gamut of a bunch of different products and services to help implement the plans we're trying to work with our clients. So let's go ahead and get started specific to our webinar tonight. As we're all aware, the markets have been very volatile, and we're going to compare January 1st through March 31st. I know we're now into early parts of May, but the markets have not changed. They've gone up at points during April and down at points during April, but bottom line, we're still significantly low. So the conceptual idea is simply if you had $500,000 starting at 8 a.m. on January 1st, your value would be worth $396,000 on March 31st of this year, which equates to a loss of $103,000. The investment vehicle is simply an S&P Dow Jones NASDAQ mix, and all three of those indexes have lost in excess of 20% during that period of time. So what does that mean? Well, for most of our clientele between 55 and 85, that's a significant loss because we don't have the time to recover those dollars. The younger age folks like Drew, they have the length of time that we don't to reacquire that. And we know as markets change, historically they'll go up, they'll go down, but generally they'll catch up. I, for example, am at the bottom of the baby boomers at age 64. I do not have the length of time as a 32-year-old to reacquire those losses. But what's more important, it's also the potential not only of losses, but if you're withdrawing money, where most of our folks are at that retirement to supplement Social Security and pensions, etc. So we utilize a rule called the 4% rule, and that 4% rule with a 60-40 split of stocks and bonds simply says if we have a dollar amount, $500,000, we withdrew 4% per year or $20,000. How long would that last? Well, that income would last for approximately 30 years. But if we put in a loss of $103,000 during that first 3-month period and we didn't even calculate any withdrawals, what would that do to our 30-year period at $20,000 per year? Well, we would lose 5 years worth of income. So instead of lasting 30 years, it only lasts 25 years. So it's not effective on you until the 25th year. Come 26th year, we have some issues. So not only is the market being volatile at this point in time, but if you're withdrawing money, it makes that hill to climb even more difficult. So on tonight's webinar, we're going to talk about some safe money strategies that we believe no longer work, that we believe could work, and we believe actually do work. And then how do we select the best from the folks that we're working with based upon risk tolerance, tax bracket, needs, longevity, income, and expenses. So why safe money? Well, it seems to make sense why we talk about safe money now when we look at what we looked at in the prior quarter, $100,000 loss. Not only was there a correction in the market, but what we want to talk about a little bit is the dark side of compound interest. If you've lost 10%, it takes you 11 to break even. If you lost 20%, it takes you 25. So for those of us who may have experienced a 20% loss in the first quarter, do we believe within the next year we're going to recover 25% of the market loss in order to get back to exactly where we were before? Well, I wouldn't be a betting man and believe that will happen, but the dark side of compounding makes this even more difficult. It's not if you lose 20, you're going to need 20 to get even. You're going to need 25. 30 brings you 43. 40 brings you 67. And a 50% loss. You have to have 100% return. Our safe money strategies, number one, things that we believe no longer work. CDs, money market accounts. CDs earn 0.5% to 1.5%. Money market accounts are less than 0.5%. In the short term, CDs and money market accounts are a very viable piece of financial planning. I know we had worked with our clients who have variable accounts from stocks and bonds to mutual funds that are in the market. We were fortunate enough to make some moves during the first 3 weeks of the year to take money from those variable accounts and put them in a safe harbor, a CD or a money market account, just to get them out of the market rather than be subject to declines of 5, 10, 15, and 20%. So in the short term, CDs and money markets will work. But our discussions on this webinar are long term. And if you're in a position where you're earning 0.5 to 1.5%, it's important that you also need to calculate what inflation is. Over the last 10 years, inflation has been 3.22%. If you were lucky enough to have a 2% return on a CD, that money still is a third less when trying to keep up with inflation. Let's talk about inflation for a moment. We've done a 30-year cumulative graph showing a $50,000, what it will cost you over a period of time when calculating 3.22 of inflation. So we know after a 10-year period that $50,000 a year over 10 years you'd have $500,000, 20 years $1 million, and 30 years 1.5. Same buying power, but if you put in 3.22 of inflation, those numbers change dramatically. And let's take it all the way to age 95 or a 30-year period. What bought you $1.5 million actually now cost you $2.378 million, or $878,000 shortfall because we didn't factor in inflation. And it's most important that we do that on an annual basis to reevaluate our plans and our assumptions that we did the previous year. We do that with all our customers on an annual basis, reevaluate what inflation was, reevaluate what our income and expenses were, and reevaluate what our real rate of return is and any changes in their individual positions. And most importantly, with the CDs and or money market accounts on long term, depending on how long they're locked up, you're guaranteed to miss the bounce back when that happens. And we don't know exactly when it will, but you'll be in a position where you're guaranteed to miss a good portion of that. Bonds. We look at bonds in today's market as almost the same as CDs and money market accounts. You have low interest rates, risk of bond funds. They fail to keep pace with inflation. They're guaranteed to miss the bounce back. Again, on a short-term basis, bond funds, particularly ones in the state of California, are a good safe harbor. Currently, those bonds that were purchasing state of California bonds from Northern California all the way down to San Diego County, those bonds in the previous years were much higher, and they were purchasing them at a higher rate. But now those money managers are buying and trading thousands of different bonds on a daily basis, and the ones that are being called are the higher ones, and so they're selling the higher ones and purchasing lower interest rate ones, which brings down the yield of those bond funds. But the advantage that we have, if it's outside of a retirement account, is that interest and or dividends that you earned are tax advantaged or tax-free state and federal, which eliminates any calculations of how much we lose based upon taxes. But again, fail to keep pace with inflation because of the current low yields. Let's review our 4% rule. The folks that we work with, we generally use between 3 and 6, depending on all the other assumptions with a client, income, expenses, tax brackets, etc. But for our calculations, as you've seen, we've used the 4% rule. It's based on a 1994 study by William Bengen. And for those of you who would like to Google William Bengen. It's a very popular financial analyst. Google that, and I forgot to mention at the beginning of the webinar, what I'd like you to also do is Google fixed indexed annuities. And I'll circle back on that. And what you're going to find is you're going to have 50% of the talking heads are going to say they're the worst thing ever. And you're going to find 50% that are saying the greatest thing ever. And that's really kind of part of what this webinar is about. We're going to open up the curtain and give you both conceptual ideas from the worst to the best. But Google Bengen and Google fixed indexed annuities. And by the way, those fixed indexed annuities, we believe they should be a part of any plan, and you'll see in the coming slides. But if you look at the amount of income or cash components that came into fixed indexed annuities last year, it was $241.7 billion, up 3% from the previous year of new money coming in of $233.7 billion. So there is a need for them. We're going to spend a little bit of time in the next slides talking about that. 4% rule again, William Bengen, maximum sustainable withdrawal rate. In our case, we use the 4% for 30 years, utilizing that 60-40 bond split. Safe money strategies number 2. Things that could work. Now this will be the 50% of the negative press that fixed indexed annuities get. Benefit of a fixed indexed annuity is you have downside protection. You put in $100,000, no one can ever take it away from you. So you're protecting your principal. Number 2, they're linked to a market index, thus the term indexed annuity. And those market indexes could be the ones we're familiar with, the Dow, the NASDAQ, and the S&P 500. We also use endemic ones to specific companies like the Barclays Trailblazer Sector 5 Index and the Schiller Index. All of them are linked similarly to an S&P 500. So you have downside protection and you're linked to a market index. And in this case, with fixed indexed annuities, you only participate in the upside of the index. So when we work with our folks, we ask the simple question, are you more concerned about upside growth or more concerned about not losing your principal? Well, a vehicle like a fixed indexed annuity provides both. It protects your downside, but in market volatility where the market's going up, you get to participate in that growth. Conversely, if the market goes down, you're protected. It's the greatest product in the world if taken care of properly, and that's what we're going to get into. Index gains are locked in every 1 to 2 years. For example, if you put in 100,000, we're going to use for our discussion a 2-year lock-in period. If during that 2-year period your 100,000 with the index you've chosen was up 10%, your value went from 100 to 110, and now that 110 is locked in. Then we start another 2-year period at that current index. If the market went down 20% in the next 2-year period, you would be guaranteed for 110 or 10,000 more than your original principal. So, downside protection, you're in the market, but not in the market. You only participate in the upside, and every 2 years, all your gains will be locked in, and no one can ever take those away from you. So let's break down what most fixed annuities have. Low caps. A cap simply says that the insurance investment company is going to cap your growth. So what we've seen is 3% to 6% caps. And all that says is during that same 2-year period, if you were able to get a 10% return, the insurance investment company caps your return at 6%, which means you'll be credited with a 6% return regardless of how great a return that you got. So in this case, 10%, you're capped at 6. You're going to add an additional 6,000 to your account, but the insurance investment company gets to keep 4,000. We believe that's way, way, way too high for the benefits. You've spent the time saving the money, you've taken the risk, and you only get 6,000 of that 10,000 gain. The insurance company gets to keep 4,000 of it. We believe that's not financially responsible for our clients. Participation rates are really the same as caps, except they're called something different. The insurance company, investment company says we'll let you participate in gains of the index. We've seen participation rates from 30% to 60%. And all that means is during that same 2-year period, if you had a 10% return and you had a 60% par rate, you would get 60% of that return, or $6,000. The insurance investment company would get 40%, or $4,000. Again, too costly for the clients that we work with. And account draining riders. They could be death benefit riders or income benefit riders. And for those of you who are watching this webinar right now, you may have a fixed indexed annuity. You may have a variable annuity, and you may not even know what kind of cap, if any, what kind of par rate, if any, and what kind of riders you may have. Don't feel alone. Individual studies through the Social Security Department have indicated 7 out of 10 folks who own indexed and or variable annuities don't know exactly what they have. Well, that's what we're for. We utilize a software package, and we're one of the few affiliates in California that utilize it, and it's called Annuity Check. And we work with, have the ability to work with 2,000 different companies who offer fixed indexed annuities. We choose to work with 3, and I'll show you later on why we choose those 3. But we have the ability to take an existing annuity account, and based upon when it was taken out, how much was withdrawn, how much was deposited, and break down what those costs internally are and come up with a real rate of return. So if you have those in our discovery call and or the questions you provide, we can certainly get you that data. I don't believe in riders, income riders, or what we call death benefit riders, because ultimately they cost an awful lot of money that breaks down the actual value of your accounts. Low returns. Well, you can see the low returns. If I got a 6% rate of return and my participation rate was 60%, I'm going to net 3.6%, and we don't think that's fair. And that's part of why we don't work with companies that have low caps, that have participation rates, that have riders, so we avoid the low return scenario. So let's go into number 3, which is our safe money strategy number 3, and what we believe does work. We believe that if you use a properly structured fixed indexed annuity that I like to refer to as a simplified accumulation annuity. And again, we're pulling back the curtain. There's no fees or charges. Those fees are specific to the annuity itself. The money managers within the indexes, the Dow or the NASDAQ or the S&P or the other two that I mentioned, they'll have a minimal fee of 0.90%, which is right along the same fee structure you're going to see in managed money. Matter of fact, a little bit less in mutual funds, which are somewhere between 0.75 and 1.25. But the difference between what you're paying on managed money and mutual funds is you have no principal guarantee. So we also have what we will work with, which is uncapped growth. Unlike the previous slides where we talked about caps and participation rates, you have uncapped growth, meaning during that 2-year period, if your 100,000 received a 10% return, you're going to get 10%, 100% of it, and that 10% now goes on your 100, and you lock in 110,000. If you were in a position that you had a 20% return, you're not sharing any of that with the insurance investment company with a cap or a par rate. You get all 20%. 20% of 100 brings your account value up to 120,000 and guarantees that 120 as your new step up in basis. High participation rate, we work with no company that has anything less than 100% of participation, meaning a 10% return, you get 100% of that return. We work with highly rated carriers, and understand we also, in this particular vehicles, you have the principal guarantee. Highly regarded companies, I will show you 3 of them that we work with. But let's talk about how the simplified accumulation annuity might fit into a specific portfolio and how it differs from some of the market makers out there now. Let's take a look at the S&P 500 from 1998 to current. Well, you can see we took $100,000 and we compared what it would look like graphically over that period of time. Well, after the first 2 years, your 100,000 went to 151,000. But because of volatility and non-guarantees during the next few years, that 151 went down to 90, and then all the way up to 2007, it was at 151. 2007, 2008, it went to $93,000. And then it steadily grew and grew up until January 1st, 2020. It was at $335,977. If we calculate the last 3 months or the first quarter of the year, that account value went to 241. So the holding period of 100,000 went to 241. Lots of volatility. Let's take a look at if we had invested at the time an indexed annuity product, and that's in the green. Well, you can see the significant difference is the money managers with S&P are a little bit more aggressive because they don't have to protect the downside. So if you compare just an investment as is with no market downturns, after a 2-year period, your account value was 151 with the S&P, 124 with an indexed product. And as I said earlier in the day, we talk to our clients and say, what's more important, the upside in the market or principal protection? And in this case, you would probably say, well, the upside is more important because you've got close to $27,000 more. But we look at what could possibly happen to derail our plan. Well, what happened is in the following year, your 151 went to 136. The significant difference is your 124 with your indexed annuity during that same year period did not share in any market loss. So you were still at 124. The following year, where your 136 went to 118 because there was a market loss in that index, your indexed annuity stayed at 124. The following year, your S&P account went down to 90,000. But because you had an indexed annuity, you didn't share in any market losses. So if we compare it at that point in time, you're $34,000 ahead with a fixed indexed annuity product. The pedal to the metal philosophy with a fixed indexed annuity is when the markets are down. We've had several thousand clients calling us over the last 30, 60 days saying, I get it now, I understand it now. because during fantastic times, we don't understand the benefit of that protection. We call it zero is our hero because we're not losing any money. So let's fast forward from 2002, where our accounts are 90 versus 124. Markets went up, fixed indexed annuity also went up, and the S&P almost went up the same. So at the end of 2007, the S&P was at 151, the indexed annuity was at 162 because we didn't share in any losses. The biggest point is at the end of that 2008, that 151 was at 93. Your indexed annuity product went from 162 to 162. You had no share in the losses. So let's fast forward all the way up till the end of our calculations, and we can see the S&P 500 was 335. The indexed annuity was 330. If we had been smart enough at that time to sell our portfolio in the S&P, we'd be in great shape. But if we didn't, that value now is worth 241, and you can see the index product stayed at 330. There's a $90,000 difference. So the purpose of this slide simply is to show you the benefits of principal protection. Now these numbers would be magnified even more if we were withdrawing using our 4% rule on $100,000. Those numbers, in order to climb back in the red, would be extremely difficult. So let's take an example of two folks, Abigail and Melinda, who each had $1 million, and they were utilizing the 4% rule, and they were going to withdraw $40,000 a year annually. Abigail decided to purchase a 60%, 40% bond portfolio with the local money manager, and Melinda decided she liked the protection of the simplified accumulation annuity. The markets. We showed in this case a 4-year period with 2 down years and 2 up years. You could put these at any point in time. These are actual 4-year periods, but you could put it where they're reverse of growth at the beginning and significant downturn. For our example, we're utilizing 2 years of consecutive market losses, which you've seen in the previous slides is attainable, and then 2 years of growth. And both those numbers work out to roughly 35%. So down for 2 years, up for 2 years. When we have those discovery calls, if you want additional information, and it differs from 2 years up and 2 years down, we can plug in any numbers. But here's what's incredible. After only 4 years, Abigail's account is down $269,000 less than Melinda's. Well, how did that happen? Well, we've shown it in the previous slides comparing the S&P with a fixed indexed annuity, but let's take a look at the bar graph. The projected growth on $1 million with a 21% loss, Abigail's account's worth $790. Melinda's account is worth $1 million, and we've taken out $40,000 on each, so Abigail now has $750. Melinda now has $960. Fast forward to year number 2. Minus 15% return has reduced Abigail's account to $637. Melinda had a 0% loss because she had the principal protection. So as a comparison, Abigail had $637, Melinda had $960. Let's withdraw our $40,000. Abigail is now at $597, Melinda is $920. Fast forward to year 3, where we've had productive return on that S&P portfolio, or 60% stock, 40% bonds. Abigail had a 14% return. Melinda, because the index products with fixed indexed vehicles are structured to prevent losses, her return was only 7%. So Abigail, $681, and Melinda went to $984,000. We withdraw our $40,000. Abigail at $641, Melinda at $944. Year 4, 20% for Abigail, 10% for Melinda, brought Abigail up to $769,380, and Melinda up to $1,038,000. We subtract our 4% rule of $40,000. Abigail's now at $729. Melinda's at $998. So the conceptual idea certainly is both withdrew $160,000. Abigail was subject to market vulnerability with no principal protection. Melinda had the opportunity to be in the market but have her principal protected, and also took out $160,000 over that same time frame, and has $2,000 less than what she started with 4 years previous, where Melinda's at $270,000 less than what she started with. So, how do we select the best? We've talked about what works, what doesn't work. And one of the things that we work with, and I talked about the annuity check, we have the opportunity of looking at 2,000 different insurance companies who market fixed indexed annuities. And again, for those of you who participate in our video conference and or phone calls, if you have existing annuities, we have the opportunity to plug that data into the annuity check software, given the name of the company, the name of the product, and withdrawals and what you put in there. We can break it all down as to what does it ultimately cost you to have those riders, and are there participation rates and cap rates that actually make your cost even higher. So we start off with 2,000 companies. 100 have been in business for 100 years. 73 have A+ ratings or better. 7 have uncapped indexes and 100% participation with 3 of them. We actually work or select for our customers one of them. We will work with 2 companies, sometimes a third, which is structured for our folks who are in the 80s. Those companies, I won't steal my thunder now, but those companies, as we talk in our discussion, are companies that we'll certainly let you know about. So we go through the process of over 2,000 companies and select the ones that fit our criteria for our clients. And that's utilizing, again, the annuity check software, which allows us to, again, compare the different products, identifies those hidden fees by figuring out what your participation rate and or cap and what your particular rider fees might be. And we also help you calculate your maximum safe withdrawal amounts. We've utilized 4% in all our calculations, but some folks might be needing less than 3%. Some might need more. We think 6 is the highest you can go. But that's a matter of risk tolerance. Again, tax brackets that you're in, what your needs are, what your income and what your expenses are. So, a couple different things, and what we believe our fees are not part of your plan. So, you've had the opportunity to listen to us talk on this webinar about some of the things we believe work and don't work, and how some of the ways that we can help you, some of the concerns about how to protect that nest egg over a long period of time by being in the market, but not being risky in the market. You've got an opportunity, as we talked earlier, to confirm a time, and I can see times have already been deleted. So thank you for those of you who have scheduled. We'll make sure that we confirm and we'll talk to you. But for those of you folks who need to ask questions, we hope you've been able to do that, and I can see we've had quite a bit. For those of you who would still like to meet in that video conference or that phone call, there are still times available for 15 to 20 minutes. We'll email you and confirm those. So I'd like to thank you for taking up the last 30 minutes of your time. I hope the information that we shared was valuable to you. And I'd like to remind you again to please take the time while it's fresh on your mind, confirm a time, set up your 15-minute video conference or your 15-minute call, and we'll look forward to seeing you soon. Again, thank you for your time, and be safe out there.